Hey, what's up everyone? It's Griffin here. Hope you're all having a great day as always. So exchange traded funds, right? Also known under their acronym ETFs. These have long been some of my favorite investment vehicles because they just offer us as investors so much different variety and options to target certain facets of the market depending on our goals as well as risk tolerance. And typically ETFs also offer lower management expense ratios and just cost overall than some other options like mutual funds. And the thing is, with literally tens of thousands of individual ETFs to choose from that trade just on even North American exchanges, obviously it can become pretty confusing trying to determine which one of these exchange traded funds could potentially offer a good investment opportunity, right? There are literally ETFs for every single facet of the market, size of company, right, in terms of their market capitalization and so on. So yeah, there's a lot of different options to choose from. Now, if you've been around the channel for a while, then you would know that I've spoken about many different individual exchange traded funds during my time on YouTube, going back even several years. And this can be difficult because there's definitely a fine line between being an investor myself for the long term while also being a creator on YouTube, right? And trying to cater to the needs and wants really of what might be more in demand from the audience and also what might be a little bit more trendy. So of course, it's only natural that over the past couple of years on the channel, we've spoken about many different ETFs, some of which have performed extremely well based on certain timeframes and economic environments, while others haven't fared nearly as well depending on overall market sentiment, investor interest, investor sentiment as well, and also the fact that liquidities have transferred from some industries towards others. So with that said, I thought it'd be pretty interesting and also quite productive to take a look at some of these past exchange traded fund videos that I made and highlight some of these individual ETFs that I spoke about and also have purchased and held in my own portfolios to see where are they at now, a year, sometimes even 2 years later, right? Because markets have changed quite a bit. We're also in a completely different economic environment and environment where investor sentiment has also shifted a lot. So that's what we're going to be speaking about in today's video. If at any point in time you enjoy it, please take a second, drop a like. It really helps the channel out and also just tells me which videos and topics you'd like to see more of in the future. Alright, so first taking a look at this ETF video that I made in early 2021, it actually did pretty well. It performed quite well with 140,000 views, but the ETFs that I mentioned there were like small cap ETFs, clean energy, healthcare, and then obviously also the S&P 500 and some broad market low cost ETFs. What's actually kind of funny though about this video is that at the beginning, as we can see here, I speak about how there's a lot of uncertainty in regards to kind of what investors were expecting for 2021 with the S&P 500 trading, as we can see here, at all-time highs once again, and that was at like 3,700, which is quite intriguing because that was in January and the market did end up running an extra 25% to all-time highs. So even considering the fact that we've seen a recent consolidation, having continued to just buy even the S&P 500 at that point right there would have yielded some really nice returns over the course of 2021. And also just a side note, it's kind of crazy to me even watching these old videos, like I've come so far in terms of just my cadence and the way I speak on YouTube. So make sure to get comfy wherever you are and get ready to be knowledged, if that's even a word. But anyways, that's just kind of a side note that I noticed watching these old videos. So we'll start off with just good old VOO here and basically any other ETF that tracks the S&P 500 since we haven't spoken about it in quite a while, right? And what's kind of interesting is that over the past couple of quarters and months, we've seen certain famous investors like Ray Dalio, for example, start actually trimming off his position in the broad market in the S&P 500. And that's kind of intriguing and contradictory to what, say, Warren Buffett has always mentioned, that for the average retail investor, it usually just makes more sense to continue buying the market actually in a low cost broad fund rather than trying to individually go and select certain companies in order to try and actually beat out the market. And so obviously an investment in, say, the S&P 500 is nothing revolutionary, it's nothing special or that's going to yield massive results. However, it's just a way that you can continuously buy into the growth of the American economy, which, as we've seen over the past several decades, has been extremely beneficial from an investment standpoint if you're actually in it for a long enough period of time and you can see that investment through. And by the way, I'm not saying here that past performance will inherently be indicative of future performance. We need to constantly, as investors, be on the lookout for new and upcoming investment opportunities and also challenging the status quo. All I am saying though is that the S&P 500 is constantly in movement as well, right? Over time, as industries gain momentum and market share, the actual weights and companies that are within the S&P 500 are in constant movement to reflect the current actual American economy, really. So losing faith in a fund like VOO that tracks the S&P 500 is pretty much losing faith in the growth of the American market, which, hey, there has been some debate about that recently, but that would definitely be a pretty bleak view of the future. So obviously, now looking back a year later, had you just continued investing in the S&P 500 at that point when I made the video, you'd still be up like over 25%. And I kind of want to just mention a video that I made a couple of months back titled something along the lines of like buy ETFs at all-time highs, because in that video, I had a couple of people mention or comment down below saying that the video did not age well and that was a ridiculous video to make at the time. And it's true that I released that video when ETFs, the broad market, was nearing all-time highs a couple of months back. But the overall general gist of that video is, how could it have not aged well, right? Okay, 2 months later, an investment in the S&P 500 that's down 10-15%, that video has not aged well? Well, obviously not, right? We should never be looking at an investment in a broad market fund like the S&P 500 with a time frame that realistically is less than a couple of years. The general point of that video is just to highlight the fact that consistently investing into the broad market is consistently investing into the growth of the American economy, and even going off of what, say, Warren Buffett is saying, that is typically going to be more advantageous than trying to individually select certain positions to, again, beat the market. Because when you project this out over a long enough period of time, pretty much no one ends up beating the broad market. That's just an absolute fact. And so yeah, if anyone's conclusion on a video not aging well, talking about the broad market over a 2-month period, well, that's something that you should probably be reassessing what your expectations are for broad market ETFs in the first place. And really, just to highlight a bit more data about this point, if we take a look at this chart right here, it showcases the S&P 500's rolling returns that between 1973 and 2016. So yeah, even though this is before the pandemic and the massive run that we saw following it, well, the best one-year rolling returns were over 60%, while the worst one-year rolling returns were negative 43%. The thing is, if we project that out over 20 years, the worst average return ends up being 6.4% on average yearly, while the best 20 years delivered an average return of 18% per year, being the 20-year period that ended in March of 2000. So really my point with this is that you can watch 1,000 YouTube videos and get really caught up in the micro, right? The short-term movements of the general stock market, but most people seriously are better off just dollar cost averaging into the broad market over a long enough period of time, and on the flip side, actually focusing on trying to increase more sources of income that you can actually then utilize to pour back into your investment portfolio for more compound interest and growth over time. In fact, I'm sure you've seen a chart like this one before, but here's a chart that gives us some data on how hard it truly is to actually time the market, and how missing out on only a couple of the best trading days severely impacts your overall returns. If you missed only the 10 best days per decade since 1930, you're looking at returns of 28% versus an average of 17,000% total return. That's pretty eye-opening. All right, let's now jump into the second broad market index, being the NASDAQ 100, right? With ETFs such as QQQ down in the US or HXQ here in Canada. And this is an interesting index because historically speaking, it actually tends to beat on an average annual basis the S&P 500, mostly due to the fact that there's a much larger concentration in tech, and tech typically can command much higher valuations than other industries, and also the growth potential is also quite a bit higher, right? So there's a reason why at this point the largest companies in the world are pretty much all tech companies, and this has shifted quite a bit over the past several years and decades, right? Where tech has really become the largest component of the American stock market, and it's also one of the reasons why an ETF like HXQ or QQQ that has like over 35% of its entire weighting towards large cap or even mega cap American tech stocks is typically going to be a lot more volatile over the long term, but also offer more potential for growth if you are going to be buying and holding over a long enough period of time. But entering a period right now where we're seeing interest rates that are going to start rising in order to counter inflation, this could very well have an impact on an ETF like HXQ or QQQ that tracks the NASDAQ 100. The thing is, tech is the future. Like, it just is. No matter how you slice it, technology is really what's helped us advance as a society and grow our economies as well as GDP and overall just economic output exponentially over the past couple of decades. And I expect that it's just going to continue doing so even at a more and more rapid pace. reading books such as The Price of Tomorrow or The Future is Faster Than You Think is really eye-opening as to how tech just is the future and is going to continue helping us grow at an exponential pace. Now, obviously we could go into detail about these books, but the concept remains that investing in, say, a broad market ETF like the NASDAQ 100 has a high concentration in these large cap mega American tech stocks that really have the liquidities available to make advancements in technology, right? We're seeing companies like Apple, Amazon, Tesla all focusing so much of their capital towards futuristic tech that's going to continue helping us grow and advance at a quicker pace. Despite the fact that we are going to be seeing setbacks over the next couple of years, like we've seen even over the past year, coronavirus, the war in Ukraine, interest rates going up, all of these things are typically short term that a lot of newer investors who may have gotten into the market over the past couple of years are seeing for the first time rocking the market. This is nothing new, right? I would actually welcome the broad market continuing to drop down. It really would not impact me because, again, I'm not selling any of these positions. I'm continuing to just take my active income and put it into my passive and my investment income, like my investment portfolio, right, for that long-term growth. So again, if that is also your strategy, this really shouldn't be of an issue to you. Hey, by the way, if you're enjoying today's video, don't forget to drop a like, really helps the channel out. And also make sure to check out all the links down below in the description. Today's video isn't sponsored or anything. So if you want to actually get some free money for opening up, say, a brokerage account with either Moomoo or Wealthsimple Trade, you'll get a bunch of free stocks for doing so. You can check out the link down below. Also, there's a couple other awesome resources there like Addy, where you can invest in real estate, actual physical pieces of individual real estate for as little as $1. Or if you want to open up a crypto account, for example, with Newton, you can get $25 for free by opening an account and investing $100 into Bitcoin, ETH, whatever coin is of interest to you. So let's get now into the next one. Now that we've covered some of these broader market indexes, let's actually talk about some more industry specific exchange traded funds that I've mentioned previously on the channel. All right, so moving into the next exchange traded fund, this is actually one that I spoke about in January 2020, 2 years ago, which is pretty crazy to think right before the pandemic ended up hitting. So completely oblivious to the fact that a month or so later, the entire market was going to crash. But we're speaking here about the XRE ETF, which is the iShares Capped REIT Index. So an ETF like this one actually invests in individual Canadian real estate investment trusts, REITs for short. And if you follow this channel, you would know that I absolutely love real estate of all kinds, physical real estate that I've owned and operated for a couple of years now, as well as REITs and even, individual paper real estate, like I like to call it, through a platform like, say, Addy, right? All of these I absolutely love. And so a fund like this one, though, can actually provide you with some pretty good dividend income because just by the nature of what an REIT is, they are obligated by law to actually redistribute a very high portion of their net income back to shareholders in the form of dividend income. So that's why you'll often see an REIT with higher than average dividend yields. And with an ETF like this one, it can be a good way to have diversified exposure to multiple different types of real estate while also getting a decent yield in the meantime. So actually taking a look at XRE's stock chart here, we can see that literally like 1 month after I released that video, the fund took a massive nosedive, basically like the entire market though, down around 40%. And of course, as we can see, it's taken a while to actually recover now back to pre-pandemic levels because this fund does invest in broad categories of real estate, including apartment buildings, residential buildings, industrial, retail, and so forth. So having that diversified exposure to multiple different types of real estate is pretty much what's allowed it to recover now. However, it's taken a little bit more time. Now, as I had mentioned in that video, I actually don't personally hold an ETF that invests in multiple different REITs because just by the nature of my investments in real estate, having quite a bit of physical residential real estate, that's something that to me was covered. And then when it comes to which types of real estate investments I want further exposure to, I'm more interested in industrial properties that I personally can't really get exposure to, at least not right now with my other investments. And then when it comes to other more specific individual properties, I actually also do like to invest through Addy, where again, you can invest into individual properties across Canada that they drop on their platform with shares as little as, you can start with $1 really. So that's also something that I've started doing. But when it comes to an actual REIT, I do hold individual REITs like Granite, which is again more of an industrial real estate investment trust that's going to invest in warehouses, logistics centers, things things like that, because I really just think that based on my own research, I think there's going to be a much larger need over the next 5 to 10 years for both residential properties and then also industrial properties, as we've been seeing a growing trend. And with growing population, I think those two facets of real estate are really where we're going to be seeing the largest amount of growth. Now, that being said, this doesn't mean that an REIT ETF like XRE isn't necessarily a good option, because despite what we saw in 2020, that was very much a black swan event. And if we take a look at a long enough period of time for real estate, typically real estate's an asset class that's able to provide you with consistent returns over time, as well as some nice cash flows, especially when it comes to real estate investment trusts like this one. And so even regardless of what ends up happening moving forward with interest rates, historically speaking, even with higher interest rates, property values tend to actually match inflation levels when projected over the longer term, which is something that we can see right here on this chart, comparing interest rates to residential real estate prices over time. And like I mentioned in a recent video speaking about the impacts of inflation as well as interest rates in order to try and combat this insane amount of inflation that we've been seeing, it is quite possible that we'll be continuing to experience a market that is trending sideways over the next year or two, and maybe even continuing to go down further, and we're going to be experiencing somewhat of a recessionary period. That is absolutely a possibility that as investors we need to be able to cope with over the next couple of years and get out of over the long term, because again, we should be focusing on the long-term growth of our portfolio and accumulating quality stocks and quality exchange traded funds, as well as other asset classes when prices are depleted. Okay, moving into the next exchange traded fund, we're going to be speaking about the iShares Global Clean Energy ETF, ticker symbol ICLN. And this is an ETF that absolutely got thrashed over the past year or so. There's really no other way of putting it. And I cannot just deny the fact that I definitely got caught up in the overall hype and momentum that this industry ended up receiving over a period of time, where there was a lot of speculation and talks about what it was the future going to be for clean energy, right? This is something that at the end of the day, I'm also human, and as much as I always try to apply sound and rational reasoning to my investment decisions, well, it's easy to sometimes get caught up in, again, the momentum and the hype that certain industries and individual companies might be experiencing, especially around certain political events, like for example when Joe Biden was coming into office, and how that would materially contribute to renewables and like cannabis industry blowing up, right? Longer term, of course, things like this are going to be beneficial, but again, projected over a longer term period of time. And despite the fact that we're speaking about renewable energy here, which is definitely in a different category than some of these other speculative or more speculative industries that got a lot of attention and momentum over the past couple of years, like for example, psychedelics, marijuana, etc. Well, what ended up happening is that despite massive growth in the industries themselves, underlying growth, well, the growth of interest towards them was definitely higher than actual underlying industry growth, which is what contributed to such rich valuations that ultimately made them come crashing down over the course really of the past year. Now, I do want to make it clear though that I've always spoken about the fact that any of these alternative industries or alternative ETFs that are outside of the realm of a broad market low cost ETF should very much become a secondary position in a portfolio, right? Like for example, some of these other ARK ETFs like ARK, ARKG that actually we're going to be speaking about shortly, well, none of these ETFs ever made up more than like 2% of my total portfolio. The bulk has always remained low cost broad market ETFs, as well as a handful of like really solid dividend and blue chip stocks. And so what ends up happening is that in periods of high momentum, it's not uncommon to see certain retail investors putting 20-30% of their position, or their entire portfolio I should say, into a higher speculation position, which is honestly kind of unfortunate, but it's something that's difficult to maybe cope with. However, over time with experience, hopefully more individuals are able to see that with a longer term perception, longer term investment horizon, utilizing broad market ETFs truly is a powerful way to grow wealth in a more sustainable fashion. So anyways, I went a bit off track there, but when it comes to the iShares Clean Energy ETF, ICLN, this is a fund that does invest in not only actual clean energy companies that are producing it, but also companies that are in different vertical fundamentals of the industry in question. So for example, like the tech that actually surrounds clean energy production. So although there was definitely a lot of euphoria, absolutely, around clean energy in earlier 2021, which definitely contributed to the massive intake of capital that we saw from March 2020 to, well, pretty much March 2021, as we can see on this chart. Well, the growth of the clean energy industry globally, though, is not an industry that's slowing down in the slightest. In fact, it is going to continue growing in demand over the next couple of decades. At the time, though, ICLN was trading for an average PE of 42x, which, yeah, like honestly is crazy. And I am not going to deny the fact that I definitely lost sight of value in this actual industry and in this investment. It has cooled off a bit though now at 27x, but considering that the actual price point is off 35% or so from all-time highs, well, this is still showing that net income hasn't really had time to catch up, and so it is still a very expensive fund on a relative basis. This would actually be a good time to segue over into the ARK funds, right? So the YouTube famous ARK-G, ARK-K, as well as ARK-F, all three of which I have spoken about previously on the channel and still hold shares of. Now, ARK-G, in full transparency, I'm down like 40% on, but I still haven't sold off any of my shares because, again, when I was getting into those positions, despite the fact that, yes, I cannot deny the fact that I was definitely caught up in the hype and momentum that Cathie Wood, like what I like to call now Cathie Wood fever on YouTube, I was definitely caught up in that and lost sight of, what a true investment should be valued at. However, I still did know that this was somewhat of a speculative position to get into and that it would take, 5 to 10 years for these actual underlying companies to really actually start making progress in the first place in each one of their respective industries, right? And so, yeah, I'm definitely down hard on each one of them. However, keep in mind, at no point I should say, did all of my positions in each one of those funds account for more than 5% total, right? So again, back to that secondary position for some of these more speculative plays, that isn't going to take away from the longer term growth potentially of my broad market portfolio funds that make up really the foundation of my stock market portfolio. But yeah, so now a year or so later, once the dust has actually settled with these funds and they're down tremendously, it's easy for someone to just say in retrospect, well, hey, I knew exactly that this was going to unfold this way, because again, most of the internet was caught up in this, like what I like to call Cathie Wood fever, and so it absolutely clouded the judgment of a lot of investors, despite the fact that, hey, like we're actually analyzing companies and looking at how these companies are actually progressing and growing over time. Looking at a fund that has is mostly composed of companies with absolutely zero profits, of course, in an interest rate environment that's going to go up, is not really a situation that's going to be favorable for a fund like this one. So moving forward, I have held on to my shares of each one of those three funds. However, in terms of actually investing into them further and dollar cost averaging, once again, this is probably not something I'm going to be doing in the near future because, well, I really don't think we're going to be seeing any type of favorable movements for companies like these really over the next year or so, especially entering the current market environment that we've started living through right now. I can absolutely understand the pain though, seeing a position down 20, 30, maybe even 40% in your portfolio, right? I'm right there with you on some of these individual, more speculative plays that had a lot of hype and speculation in 2021. Ultimately though, hopefully as investors, we can just take this as a learning lesson and continue to focus on really the fundamentals of what makes up a good company for a long-term hold, and also really refocus our efforts towards really strong and solid exchange traded funds. So I hope you enjoyed today's video. If you want me to do a part 2 of this, because again, I've spoken about a lot of different exchange traded funds over the past couple of years on the channel, make sure to comment down below and I'll try to make a part 2 in the near future. If you enjoyed the video, make sure to drop a like. It really helps my channel out and tells me what type of content you'd like to see more of in the future. Don't forget also to check out all the links down below in the description. You can get $25 for free with Addy. You can get 3 free stocks up to $4,500 a piece with Wealthsimple, bunch of free stocks with Moomoo if you're American, and some other freebies down below in the description. So with that said, thanks a lot for watching today's video, and I'll see you in the next one.